Hi. Today I just wanted to um, comment or maybe share some my own insights on a very commonly taken up topic, which is around investments. I mean, we all are majority of us are like salaried people, and we would want to save from time to time and put our money in some kind of an investment which can give us some returns. Now returns is one aspect of it, but the other very important aspect is the risk associated with these investments. So as we all know that today probably everyone is talking about investing into the market like mutual funds and all. So the news that actually caught my attention was the interest rate cut in employee provident fund. So as you can see, there has been a minor decrease in the rate of deposits to be given to the employees provident fund deposits to all the salaried employees. And if I may show you the last 10 years rate of interest on employee provident fund, it was last time it was 8.5%. That was in the year financial year 2012 2013, and then it was increased by 25 basis points, then another 5 basis points, then a reduction of 15 basis points, another 10 basis point reduction, then again an increase of 10 basis points, and now finally a decrease of 15 basis points, bringing it back to the levels of 2012 2013 8.5%. So obviously people tend to ask, and there is a mentality that the moment you have an interest rate cut in fixed deposits or provident fund, people look for alternate options to earn higher rate of interest. So here I'm just going to probably show you my experience from the market. So what I have done is I have put down a small Excel sheet here, which over the last 10 years, what was the provident fund rate given by the government, and what is the market rate return. So if I just give you a very high level example, if you just Google, you will find that the average stock market return for the last 10 years has been 10% annually, but that is before inflation. So mind you, this is before inflation. When we say before inflation, then obviously this particular parameter plays an important part in terms of reducing your overall return. So I must caution everyone on this point that whatever dashboards and graphs that you look at when you invest in mutual funds on share market, those returns are on the graph. They are without the impact of the inflation or any exit loads and things like that. Whereas the returns that you get on EPF is completely free from tax or any other impact. So if we just take a small example with a very basic calculation of, let's say somebody is investing either 100,000 rupees or 1 lakh rupees every year in EPF or in the market, then what would be the EPF corpus and what would be the market corpus? So very simple to calculate, because in EPF the rate of interest is also calculated on the previous rate of interest. So you will find that in the first year it is, if it was like 8.5%, then it will be like 1 lakh. So I've taken this reverse, but then again, if you even if you take from down to top, bottom to top, again it will be the same calculation. So maybe we can just reverse the years from here, from top to bottom, and you will still find that at the end of 10 years, the 10 lakh rupees invested in an EPF, which is uh, 10 million, becomes 16 lakh 23,265 rupees, and this is completely tax free. Whereas if we take an average return of 10% from the market, then the market corpus becomes 17 lakhs 53,117. So on paper, on a chart, it might look good that yeah, I'm getting better return from the market, but the moment you try to withdraw from the market and you see the impact of tax and inflation, so even if we take a very minuscule percentage of like 3%, you'll find that EPF return is still 22,441 rupees higher as compared to the market return.